Sound Cartel.
On Tuesday, the 12th of May, Federal Treasurer Jim Chalmers handed down what may become one of the most debated budgets in years, delivered against a backdrop of global instability, persistent deficits, rising geopolitical tension, and growing concern about the strength of the Australian economy. So what does it all mean for small businesses and the wider economy? In today's Business Essentials, economist Professor Robert Brooks from Monash University unpacks the balancing act between inflation, growth, interest rates, housing affordability and recession risk. He also explores what it means for small and medium businesses. Then tax advisor Michael Jones, a partner at Forvis Mazars, explains the proposed changes to capital gains tax, negative gearing and family trusts. He also outlines the potential impact on investors, startups and business owners. Together they explore whether the budget builds long-term resilience or simply shifts today's pressures into the future. From Sound Cartel, I'm Grace Jennings-Edquist, and this is Business Essentials. Our first guest is Robert Brooks, a professor of econometrics and business statistics from Monash University. The new budget contains measures aimed at supporting business investment and easing pressure on households. But there are also loud calls about inflation, productivity, recession, and whether the government is doing enough to prepare the economy for what may come next. And for small businesses already feeling the squeeze, the question is whether the reforms make an economy already under pressure more difficult to navigate. Professor Robert Brooks from the Monash Business School joins Nicole Goodman to discuss. She begins by asking what Australia's biggest economic challenges are that this budget needed to address, and is it likely to succeed?
So I think there's probably three main dimensions to it. It is really clear compared to where we're at the start of 2026 that the conflict in Iran has given us a whole series of economic challenges that the government wasn't planning to have to address. Now, some of that's clearly beyond our control, but some of the initiatives in the budget are in a response to that. So the budget did clearly have to address that. The second issue that the budget had to address is this long-term structural deficit issue of, how do you manage both taxation and spending? And then the third issue that the budget had to address is this question of the tax burden falling on households and labour income in both a wage and salary sense and in a small business sense.
The government is still spending more than it earns, and that's not expected to change for another decade. Does this budget do anything meaningful to address the structural problem, or does it effectively kick the can down the road?
So I think the budget responds really in two ways. On the taxation side, it's a view that the tax burden that falls on labour income is currently too high, which I think is a reasonable enough view. And there's a reframing of some additional taxation, predominantly on what you'd broadly describe as capital income. And on the spending side of the budget, it's really clear that the big initiative areas are with respect to the future of the NDIS. Now, I think everyone agrees that, the NDIS and spending has to move to a more sustainable footing as part of the social licence of that really important initiative. The issue on there is going to be in implementation. Can you do this in a way that works to bring spending to a more sustainable level, but continues to provide important supports to people who need it?
Rob, ahead of the budget, there was a lot of speculation about changes to capital gains tax and negative gearing. Now that we know what was announced, what do the changes mean for property prices and housing affordability in the real world?
Sure. So the government has made, an initiative around both the capital gains tax and the negative gearing, and they've clearly pitched that as a housing affordability measure. Now, what most of the analysis tells us is that the effect of these changes are going to be to moderate the extent of property price rises by a small amount, but they are going to be an amount that does that. And the critical side of the housing affordability piece is also the material that relates to supply. So in and of itself, housing affordability is clearly not purely a demand problem. It is also a really important supply issue. So we've seen the tax mix changes think about demand, and they will work to provide, some moderation to demand. But supply remains critical. So the initiatives announced around infrastructure and the initiatives announced around, some simplification and deregulation as it relates to construction are actually extremely important. The key matters that remain around housing affordability is about supply. Supply must be pivotally addressed as part of that. And so the tax changes have had a lot of important highlighting, particularly given the pre-election commitments of the government. But it's extremely important to address the supply side as well.
Is this a budget that the Reserve Bank would welcome or worry about? And where do you think inflation and interest rates are headed over the next 12 months?
I think the bank has been really clear in what it has said in its announcements this year, that it is concerned about demand pressure in the system, and it's also concerned about government policy settings creating too much demand pressure and making the inflation settings more challenging for the bank and requiring more of a policy response from the bank. So what I think the bank would have been looking for is you didn't want to see a situation where you had cost of living relief going that would create more discretionary spending. So on that ground, the budget has done that because, the tax offsets that are planned are delayed. So I think that's a desirable thing. And the bank would have not wanted additional spending coming in. So by and large, if the spending that's announced can be implemented well, they are a positive situation in there. But I think on balance, the bank would think that we haven't added to inflationary pressure. The challenge that the Reserve Bank and the government faces, however, is that the big inflation risk pressure in the system is not something that we can control. As is pretty clear in the budget scenarios, we've got a base case scenario where oil prices are not going up significantly from where they currently are. Perhaps they moderate a bit, but they clearly don't moderate back to where we were at the beginning of 2026 before the conflict. But we have also got in the analysis, a worst case scenario where oil prices are significantly higher. And in that scenario, inflation risk is much, much higher. And there is also more risk for economic growth and for unemployment in that scenario. That getting into a stagflation scenario is clearly the worst case scenario for the bank because it makes it much harder to fight inflation with monetary policy tools without having a bigger impact on economic growth and unemployment. So our challenge on that is, of course, that's all outside of our control. So, what would the Reserve Bank want out of a budget? It would want a budget that doesn't create additional inflationary pressure because let's hope we don't end up in the worst case scenario. And the market pricing to date, around oil and energy, markets are not pricing being up in that worst case scenario either at the present point in time. But you need an insurance option that if things got into a more difficult situation, you don't end up in that much more awkward stagflation situation to have to manage. I think on balance, there would be a comfort perhaps around, the tax mix change and trying to think about labour income and more broadly defined and around some spending restraint.
Well, let's talk a bit more about unemployment because it has remained surprisingly low despite high interest rates. Do you expect that to continue or are we likely to see a softer labour market and rising unemployment over the next year?
The Reserve Bank has really been very clear in saying we see a major risk on higher inflation translating into higher inflationary expectations, and higher inflationary expectations are then really undesirable because they then come through into both prices and they also come into wages. Now, what I think is interesting about the higher inflation environment that we've had so far, and also in terms of the Reserve Bank changes, is we haven't really seen a cycle of wage inflation and unemployment changes happening. So that, I think, is the risk that people are trying to manage really carefully. You don't want higher inflation to become embedded in higher inflationary expectations because those higher inflationary expectations become then embedded in higher wage inflation, and that higher wage inflation becomes a real challenge in the labour market in that particular setting. So I think that is really extremely important around the inflationary expectation setting. What has remained really interesting in the whole monetary policy setting, we've probably been in now for the last 18 months, is that wage pressure hasn't come in to the system perhaps as much as people had been concerned with. And I think that has been related to inflationary expectations perhaps not being as embedded into the system. There is some concern that those inflationary expectation issues are a genuine risk, and the longer we have international conflict and geopolitical tension, and the longer we have higher oil prices, the more we have that risk. So I think our risk around that remains for a period of time, but the base case scenario forecast is that we're not ending up in a dramatically different wage inflation or unemployment situation.
What does that mean then for wage pressure and hiring for small businesses?
At the minute, a lot of the policy settings are about managing that inflationary expectations setting. The other dimension to this around small business hiring and small business situation is that while a lot of the tax mix changes are clearly focused on particular horizontal equity issues and particular housing affordability issues, we do know that small business as a corporate structure makes use of the trust arrangements as well, and they make use of the trust arrangements for really good business reasons. So there is a risk on the hiring situation that as people work through the implementation piece of that has impacts. Now there's been some post-budget, analysis of that, and there's clearly been some consideration of transitional arrangements around that. And I think that's why the trust changes are on a different timeline to the negative gearing and the capital gains tax changes, because there is a recognition that people in certain small business and family business settings are going to have to think about their corporate structure and how that's worked on.
Does this budget give us the tools, do you think, to avoid a recession, or has it made the risk worse?
Our risk of recession is largely still going to be driven by international factors. So I don't think the budget in and of itself alters that. What the budget needs to have done is made sure that we're not in a situation where if international factors become worse, we've got less tools to be able to manage that situation. So I think in that sense, our recession risk will largely be driven by external factors that we can't control. What the budget and what our economic policy settings must do is give us better capacity to be able to manage that if it occurs. So I think, not adding inflationary pressure, having some attempt to address spending issues, thinking about tax reform genuinely, which has actually, been the interesting thing out of both the budget and the post-budget reply. We've actually now got a tax reform discussion happening in a much more meaningful way than we had previously. That's actually a really desirable thing. That is actually a good thing to have happened. Recession risk remains for us something that has to be managed, but it's an externally driven factor.
Is there a case, do you think, that a mild recession would be good medicine? In other words, do we actually need a recession?
Well, I'm of the age where I can remember recessions that we had to have, to use a famous Treasurer term from a very long time ago. So, the view on those recessions that we had to have, if you think back to that time, the view at that time was that Australia, like a lot of other economies, had inflation hangover and inflationary expectations that were too high out of the 1970s shocks and hadn't had to be managed out of the system. And so what happened, in the US a bit earlier, but in Australia a bit later, were a lot higher interest rates to drive down inflation and to drive down people's inflationary expectations. And painful though those policies were, they were successful in driving down inflationary expectations, and it got, Australia and the US and Europe and lots of other parts of the world into a much better inflation management situation for a longer period of time. That's why I think the Reserve Bank and the focus of a lot of others is on this managing inflationary expectation situation. You only need to get into those scenarios when you've got an inflation problem that's fed into higher inflationary expectations. We're not in that setting at the present point in time, but we also don't want to be in that setting either, because you cannot get out of that situation without it being a lot of economic pain for consumers and for business and for the country. That's not a situation that we want to be in. So all our policy setting should be around managing inflation so it doesn't become embedded in inflationary expectations.
For a while now, it's felt like small businesses are really being squeezed from every direction. What are the likely flow-on effects from this budget for small and medium businesses?
So I think it certainly is correct to say that, small and medium businesses have faced a lot of cost pressures in recent times. So, why have they faced those cost pressures? So part of that cost pressure more recently has been, clearly higher distribution and freight costs associated in part with oil price shocks, and also associated in part with efficient functioning of freight and distribution markets. So in terms of that, we've seen a budget initiative, and we've pretty much seen a bipartisan position to say that we've got to have greater fuel security in terms of fuel supply. So I think that's a desirable thing. So that clearly helps with that side of it. All that said, ultimately fuel costs are driven by global markets that are beyond our control, and the better long-term outlook on that is reduced geopolitical tension and an absence of conflict. But we can't control that bit of it. But the bit we can control is how our markets function. So that's in a better space than it was immediately after the conflict. So that's a desirable thing. The second issue we've seen, which has been really important for small and medium business, have been energy costs for a period of time. So we know energy costs are really important. After the Russia-Ukraine conflict, we got into a really difficult situation in terms of a significant gas price spike, and that fed through into much higher energy costs for everyone. What we have seen is a policy now about getting a better policy around the functioning of the domestic gas market, and also around behaviour around more domestic supply. So I think that is a desirable thing. The other thing we've seen out of the budget is a view that, we need to reduce some of the regulation burden on small business, and we need to reduce some of the red tape. Reducing regulatory burden and compliance costs is clearly a desirable thing. The other budget piece that we've ended up with, I think that's really been interesting, and that's now actually become bipartisan, is this instant asset write-off arrangement that help facilitate business investment. So we've pretty much now got a situation out of, policy up to the budget, out of the budget policy, and out of the opposition budget reply, where we've now got a bipartisan view that instant asset write-off is desirable. The fact that we've now got a consensus that having this is a desirable matter and it does facilitate business investment.
It's also true to say that small businesses live and die by consumer confidence. And most economists agree that Australia's had a productivity problem for years. Where do you see real GDP growth heading over the next 12 to 24 months? And what will determine whether businesses feel genuine improvement?
So it is certainly the case that consumer confidence is lower than it was, and consumer confidence being lower than it was is not desirable for GDP growth, and it's not desirable for business activity more generally. So part of the hit on consumer confidence is clearly in terms of the fuel price shock, and it's clearly in terms of some of the fuel distribution issues that we had, in the period immediately after the commencement of the current conflict. So in terms of the fuel price shock issue, fuel prices are going to be driven by global factors. Those global factors are beyond our control. We would hope that the geopolitical situation and the conflict situation ends up better than it currently is in the second half of 2026, but we can't control that. That said, the market pricing of that is still consistent with being some distance from a worst case scenario around that. Now, it's not back to the beginning of 2026 by any means, sure. The other question where we've got into a challenge with the consumer confidence piece has been around people trying to work out where the Reserve Bank is at with interest rate settings. So it is pretty clear that if people think that interest rates are likely to continue to have to move up, and that then does have an impact on people's discretionary spending and confidence, that is a potential risk factor. That's why this whole focus on the inflationary expectations material has been extremely important and a really critical thing to have been done. So that's a desirable thing. The productivity issue has been a challenge for a significant period of time, and there's been a lot of work done on that. And how do you unlock greater productivity? Now, all the comments in the budget have also been framed around, let's get productivity moving, let's try and cut burdens into the economy, and let's move to greater flexibility where we can have it to get in a better setting. They are extremely desirable policy outcomes to have, but they've got to be delivered at the point of detail around that productivity material.
That was Professor Robert Brooks from Monash University.
If you're building a business, your reputation is everything, and a podcast can help build trust at scale and turn your expertise into authority. Sound Cartel's new Thought Leader package is designed for business owners who want impact without the overwhelm. So we handle the strategy, production and launch, while you can stay focused on what you do best. You can book your free 20-minute strategy call at soundcartel.com.au.
Now to the tax implications of the budget. Many are calling it one of the most significant tax reform budgets in decades, with sweeping changes to capital gains tax, trust structures, negative gearing, and the taxation of investment income. Supporters say the reforms are about fairness and housing affordability. Critics argue they fundamentally change the way Australians invest, build wealth and structure businesses. So what was actually announced, and what does it all mean for investors and, importantly, business owners? Joining Nick Schilberger to unpack the tax implications of the federal budget is Michael Jones, partner at Forvis Mazars. Nick starts by asking Michael about the government's announcement to replace the 50% capital gains tax discount with cost-based indexation.
It's from 1 July 2027, so there's a bit of a way before it starts. And at that point, the 50% CGT discount will be replaced with a system that adjusts the assets cost for inflation, which we used to have back in 1999, and that's just called an indexation. But another really important change is that there's a minimum 30% tax on capital gains tax after 1 July 2027. So instead of halving the gain, which has been the case for decades, the purchase price will be adjusted before inflation, before calculating the gain and then subjecting it to tax.
Is it going to be more complicated to calculate than a simple 50%?
Perhaps. It's just that you're going to be paying more tax. This is really significant thing. You watch debate and the language is about clamping down on the capital gains tax rate. And it's very biased language, because the idea that you tax income and capital the same is really nonsensical. One, with capital, people make investments, there's risk, there's a long term before you get a return if you do. And besides that, you've already paid tax on the money and then you invest it, right? And then to tax it as income is, I think, misguided. So the calculation is not the issue. It's just taxing capital gains without understanding the consequence, because I think it will make a difference to investment and it will make a difference to innovation in this country.
Now, you mentioned in passing there that the capital gains are also going to be subject to a minimum 30% tax.
Yep.
Is that going to be significant in practice?
Yes. And it will also include pre-CGT assets, right? So that if you acquired an asset before the introduction of capital gains tax in 20 September 1985, that asset's been not subject to capital gains tax. That's now changing. Well, 1 July 2027 it'll change. So it's 30% minimum, but it'll be up to 47. So
Yes.
I'll give you just an example that's not too fanciful. And it's about, the biggest one is for startups and innovation, So if someone starts a company, they've got a nominal $2 cost base. It's all about their effort and their brains and their creativity.
Start with nothing.
Start with nothing. Build it. And these are our clients. We have people that do this, and it takes decades. And then if everything works, they sell for a lot of money, but it might have taken them 20 years or more. Anyway, sell for a lot of money, the indexation gets adjusted and they're taxed at 47%, That is, I think, a real issue in this time of innovation that we're living in this time where we want more productivity and creativity. And there's an appetite for people to be doing things and being more hands-on. That's one side. Will it help housing? I don't know. Maybe it will, and maybe that's a good thing. But at what price? At what price to the Australian community? So, yeah, it's quite a shocking change.
Yeah, the focus of the budget's been about investing mainly in property and in shares, but it's that investing in business that we don't want to discourage as a country.
We really need it. And the language is about rewarding workers against others. And I find that unhelpful way to frame tax reform. So winners and losers. We'll all be paying more capital gains tax. Winners, I guess you could say, if you already had an asset that you've owned for a number of years, that'll be taxed at using the discount up to 1 July 2027. You may not feel like a winner, but relatively you're a winner. The other winner, though, just quickly, is probably superannuation, which has not had any changes in this budget. So if you've got a self-managed super fund in particular, where you can manage the assets, you've got a tax rate of 10% on capital gains. And that sort of tax rate for an investor really, over the long term, enables compounding and is an encouragement for investment. And of course, if you hold it till your retirement, it's zero tax rate if your balance is less than 2 million. So I think self-managed super funds are winners, and losers is probably everyone else. And hopefully, though, there is some improvement in availability of housing.
Well, that's the hope. We will see. Another major reform is the restriction of negative gearing on residential property to new builds only. What impacts is that going to have on investors and housing supply and also property prices?
Let's just talk about how it works.
Yes.
So again, it's from 1 July 2027. The negative gearing will be limited to new residences, as you said. But also there's a carve-out. So if you did own your property before the 12th of May, the budget night, then you can continue with the negative gearing. But going back to that future point, it'll only be available for new builds. So if you buy a property after the 12th of May, you won't be able to offset any loss against your salary. You can offset it against future rent and future gains, but not against your salary. And the pre-May 12 properties are grandfathered. This is only for residential properties, and the commercial properties and other classes, such as shares, you can still do negative gearing.
So taking all of these changes into account, can I run a quick example by you?
Yes.
What if someone has purchased an investment apartment a few weeks ago before the budget, but it hasn't settled yet? So they're kind of stuck in a bit of limbo between the two. What's going to happen there?
Well, they'll end up in the winner's bucket because, if you've entered the contract, then it's considered owning it for these purposes, for tax purposes.
Okay, so they're in the winner's bucket. Excellent. Moving on to family and discretionary trusts. They're now going to face a minimum 30% tax rate on distributions. And trusts have been central to many investment and business structures for decades. I think you said before, back to the 1970s.
They started popular in the 70s, yep.
So this is going to be a big change. Does it mean the end of trusts?
This is an enormous change. It's certainly the end of an era. It may not be the end of trusts, but an end of an era. And this is how we imagine it's going to work. If you look at today, when a trust distributes income to beneficiaries, the beneficiaries are taxed at their marginal tax rates. If the trust accumulates income, it will pay 47% tax on that income. And that's why generally trust income is distributed. Now, what's extremely common practice is you have something, it's called a corporate beneficiary or a bucket company. If the trust distributes to the corporate beneficiary, it'll pay either 25% or 30%, depending on the activity of that corporate beneficiary. And the franking credits that that trust might have will also flow to the company. Now, from 1 July 2028, so this is now a further year out, the trustee will pay a 30% minimum tax on the taxable income, including capital gains, right? The beneficiaries that receive that income, individuals, not a corporate is separate, we'll come back to that. Personal beneficiaries get a non-refundable credit for the tax that's been paid. And the franking credits received from the trust can be applied against the trustee tax. So it means you can never distribute income to anyone and it's taxed at less than 30%. Excluded from that 30% tax are unit trusts, widely held trusts, super funds, deceased estates, charitable disability trusts and primary production income.
Now, you mentioned corporate entities. There's going to be a double taxation on distributions to those. So that's a real double whack, isn't it?
So in that example, we talked about you can distribute to individuals or corporate beneficiaries. This change means you will not be distributing to corporate beneficiaries anymore. So from 1 July 2028, you will effectively be doubling the tax you pay when you distribute to a corporate beneficiary. So the trust earns the income, pays a 30% withholding tax, distributes to the corporate beneficiary, but the corporate beneficiary gets no credit for the trust tax. And then the corporate beneficiary might frank that income out to a shareholder eventually. The end result, it's a double of the tax, up to 60%, maybe more, on that trust income. Now, I'm pretty sure they knew what they were doing and they meant to do it, but it's a shocking move.
And that just means that you'll have to find another way for your clients to be distributing their money.
This is day 3 of the new world, Nick. What the government wants is people to move out of trusts and transfer into companies. We don't know a lot of the detail, but there'll be rollover relief to transfer assets to a company. But my consistent experience with government rollover relief is it's often quite narrow. It doesn't work well. I mean, this move is based on the idea that, those people with trusts, they're the bad people, and we're going to close them down and do this. It's not a sympathetic environment that takes into account that people have been doing this for 50 years. It's a sort of broad labelling, and that's a real problem.
And Michael, could you expand just a little bit on that rollover relief?
The idea is you've got a 3-year window to restructure, and it starts on 1 July 2027. And it's to support taxpayers moving out of trust into companies or a fixed trust structure. So it's only for 3 years, so we need to start thinking about that now. And there's a whole lot of variety of things to weigh up. I guess the main point at this point in time is to understand there's rollover relief and you've got a 3-year window to do it, and it starts 1 July 2027.
So taking all this into account, do these measures represent a broader philosophical shift in how the government wants to tax wealth and investment in Australia?
Yes, and the government needs to raise money, and it is taxing wealth more than it has ever before. The number of examples over the last couple of years at a state level and at a federal level. By doing it with capital gains, I think there's significant bad consequences because it discourages people taking risk and making investments. It discourages people starting up things from scratch, being creative. That's a real disappointment.
So for business owners and investors listening today, should they already be reviewing structures and investment strategies, or is it too early before the legislation is finalised?
No, I think they should start be thinking about it now. And we'll need more detail, of course, but in terms of structures, definitely we're already talking to clients about it. It's an important thing to consider.
All right, there was a lot in the budget, and we haven't got time to cover it all, but I do want to just sort of quick fire around here. 4 other business-related tax measures from the budget. I just want a quick one-line answer if you can. The first one, refunds for tax losses for eligible startups.
Okay, so that starts 1 July 2028, and first 2 years of a company's life with a turnover of less than $10 million can get some money for their losses, okay? Interestingly, the refund is capped at the FBT and PAYG withholding paid on Australian wages, which means what they want to do is encourage employment rather than the usual sort of founder or contracting basis.
But that's a good one, because we did talk earlier about disincentivising startups.
It's a good one. How big, I don't know. And I hope we'll see more startup incentives. Yeah. But look, incentives are always complicated and have strings. Why not just open it up, Nick?
Yes, it would be nice. The second one, the return of company loss carryback rules.
Okay, this is available from 1 July 2026, okay?
2026?
Yes, and it's a permanent measure. It's for companies with less than 1 billion turnover. They'll get a refund on tax paid in the prior 2 years by using current year losses. So they've paid tax on income for the last 2 years, they've got a loss. So it helps cyclical businesses, like construction, farmers, things like that, winemakers.
Yep.
It's revenue losses only, and it's capped by the franking account balance.
The third one, the permanent $20,000 instant asset write-off.
Okay, great. I mean, remember, it's been on for so many years. Look, of course it's good, and our clients really like this, but, $20,000, it's starting to be a bit too small, for capital expenditure, I think. We want it to see more than that, and it's welcome.
Start lobbying for $40,000 next year.
Yeah, more meaningful amount. I agree. Let's start talking about it.
And the last one, in the phasing down of the electric vehicle FBT exemption.
Yeah, I'm glad you said phasing down, because often these announcements you think, oh, that's great. This one, it's great that there's something there, but it is a phasing down. So currently you have a electrical vehicle FBT exemption for the right sort of amount of cars. This is a transition. So it goes from 100% exemption to a permanent 25% fringe benefit tax discount from 1 July 2029. So the way it works is that the current rules remain until 31 March 2027, where vehicles less than or equal to $75,000, provided it's before 1 April 2029, get to keep that 100% discount for the life of the arrangement. Going forward from that, vehicles between $75,000 and the fuel-efficient LCT threshold will get a 25% discount if they're provided between 1 April 27 and 1 April 2029. Now, as a planning point, this rate is locked in at the start of the arrangement, so bringing forward novated leases before April 2029 preserves the sort of full exemption for the full length of time of the lease.
So finally, Michael, looking at the federal budget as a whole, do you think it creates confidence for the small business sector or more uncertainty? And what should business owners be focusing on now as a result?
Well, I think that it doesn't create confidence. I don't think it's a good one for small business. The changes that they've provided are quite small against the significant, very, very significant changes to do with trust and capital gains tax. And these are such important measures for our small businesses. So uncertainty, I think it's certainly bad for small business. So people, they've got to sharpen the pencil. They've got to start thinking. It's not the end of the world. It's just another budget, but it has serious consequences, and you need to understand what it means for you and your business.
That was Michael Jones, partner at Forvis Mazars. Thanks for joining us for this week's episode. Follow Business Essentials podcast across social media and head to businessessentialspodcast.au for more. Business Essentials is a Sound Cartel podcast. Producers are Nick Schillberger, Nicole Goodman and myself. Technical production is by Pete Letts. I'm Grace Jennings-Edquist. Thanks for listening. We'll bring you more Business Essentials next week.
Sound Cartel.